Welcome to episode 40 of Kontrarian Korner. I'm Ben Kelleran. Today we have another return guest on to talk with us about the coal sector. He's the resident expert and runs the Coal Trader Substack and is a very entertaining follow on Twitter. Matt Warder, thanks for coming back.
Hey, Dan, thanks for having me. I don't know how entertaining I am, but I try a little bit, do the best we can.
Yeah, well, I've been interested in the coal sector for, I guess, a couple of years now. And it's been interesting to follow because I think it's, I've kind of compared them a little bit to the tobacco stocks of, I guess, 15, 20 years ago, as far as the capital returns, the dividends. But I think it's a pretty interesting place to look as far as a capital starved industry. But I think if you could start with giving us the high level overlook for thermal and met coal and kind of maybe lead off with that, and then we can take a look at some of the companies you guys follow.
Sure. So, for the coal sector, 2025 was always going to be a year that is not quite as good as we've seen in the past for a couple of reasons. Number one, on the Met side, there are a number of operations that begin to sort of ramp up around this time frame. There is, Lear South just had a fire, but they'll probably return to production here this year. That'll be, up and running again at full blast 12 months from now. Blue Creek at Warrior is ramping up. They did 170,000 tons of development coal, but eventually that's going to be, 4.5, 5 million tons of high vol A. Centurion from Peabody is producing first coal as we speak. That'll be ramped up by 2027. You have the Elga mine in Russia, which will, put another 6 million tons of high vol A type product on the market. So this was always a year where we knew that supply was going to get bigger, and we knew that demand was at least questionable as to which direction it was going to go. Because China peak steel, when I was at Wood Mackenzie like 10 years ago, we were projecting for 2023, and I think that's right around when it was, 23 or last year or whatever. But either way, China's plateauing, and now India is starting to ramp up. And the question is, can India ramp up faster than China declines? That's what we don't know yet. But regardless of that, there's going to be more coal available to the industry, just from mines that are coming online in the next 12 months than there was in 2024 or 2023 or 2022 when we had these huge price spikes. So this year is what I anticipate to be the cycle trough. And then as we move into 2026 and get into 2027, there are some key depletions that happen on the met coal side. There's Oakey Creek from Glencore in Australia that pulls another 2 million, 3 million tons off the market. Dendrobium was supposed to come offline. Now we don't quite know because that asset has changed hands. There have been now 4 bankruptcies in Central App, which have pulled about 2 million tons total off the market. And we expect there to be more of the very, very small producers, the undercapitalized producers as we go forward. So right now the market is in a 12-month period of digesting all of that, whilst it also kind of absorbs a Chinese steel industry, which has yet to adjust to lackluster downstream demand in terms of real estate. So Chinese stimulus could help solve the problem a little bit. Trade cases brought against China could help solve the problem a little bit. It's currently raining to beat the band in Australia, and there are a lot of floods. That could help solve the temporary problem, but this supply dynamic was always going to be in the cards for this year and next year. And so, if you looked at forecasts from a couple of years ago, everybody sort of bottomed out around 2025 and then began the up and to the right at a 10-degree angle sort of forecasts from there. On the thermal side, it's a little bit different because you have to sort of think about things regionally now. In terms of the Atlantic Basin, we have U.S. LNG export facilities coming online. So that to some degree will alleviate tension in European TTF, NBP sort of gas prices, which should temper the upside for coal during periods of high demand. So now we have the possible end of the Russia-Ukraine conflict And would that free up thermal coal from Russia to be exported into Germany? We don't know yet. For now, I'm assuming that sanctions in Europe will probably stay on Russian coal, and it'll be more of a gas-driven narrative. But either way, 2025 again should be a not so great year compared to the years prior, and that'll probably bleed over into 2026. For each of those commodities, though, we're still short power demand as AI builds out, regardless of what anybody thinks of the ramifications of DeepSeek. If you're a believer in Jevons paradox, like we saw with efficient appliances, energy efficient appliances, we'll just use more compute later on, and we're still short electrons. So I think as we get into the back half of the decade, things look still pretty good. And these next couple of years are probably when you want to, if you weren't able to participate from 2020 up through early 2024, these next couple of years are the period where you'll probably get a chance to re-enter and have, a couple of, not going to be any 10 baggers this time, I don't think, but 2 baggers, 3 baggers are probably going to be on the table for the next part of the cycle.
Yeah, interesting. I would like to kind of maybe see if you could pull apart and elaborate on the Chinese impact on, as far as their economy goes, on kind of different coal, met and thermal, but then also maybe if you could talk a little bit about the tariffs on steel and aluminum, how that might be playing a part moving forward.
Sure. I tweeted today, Trump just delayed the tariffs until April 1st. So I made the tweet today, like this is the best time to be a market analyst, because everything you think is going to come true is absolutely not.
Yeah. You're going to get there. It's going to be April Fool's. So
right, and then they could kick that can down the road for a year, because they're using these as negotiating tactics, not it's not permanent policy. So for analysts, that's a double whammy. Like, are we serious about implementing these and leaving them in place the way that we did steel tariffs in the first Trump administration? Right, Biden didn't change any of that. So now we're tacking on another 25%, and where does that leave the economics? Meanwhile, we get we called off the tariffs on Canada and Mexico, but we're putting tariffs on steel and aluminum. Well, where do you think a lot of that steel and aluminum comes from? It's a big portion of Canadian Mexican imports. So I don't really know what they're doing. I don't really understand what the strategy is. All we can do is sort of react to it, and in a box, in a nutshell, the tariffs on Canada and Mexico just make things more expensive for the U.S. So in that sense, you're probably long U.S. steel producers, short Canadian steel producers, or long U.S. aluminum, short Canadian. That's as best as I got for an answer on that. For us, it just means prices are going to go up. For domestic coking coal prices, that's probably constructive. When we get into next year, we'll probably have domestic prices that are on par with what they are today. It's about $150 at the mine for low vol. It might even tick up a little bit. Maybe you can get 160 out of it. That will help balance out the U.S. met coal producers' portfolio with regard to exports, because I don't think the export market is going to be quite as robust. So net for coal, it's probably fine. When we start getting into Chinese tariffs, China's already put 10% tariffs on U.S. coal. Now, that's not a huge amount. It's only about 10 million tons. It's about a sixth of our exports or whatever. But the coal that's going over there, which is mostly CNR's Bailey and Coronado's Buchanan, I think at the moment, those coals the Chinese really like. Bailey gets a huge discount relative to PLV, so that probably stays. I figure the Chinese will probably just pay the 10% tariffs on that and continue to take it. Buchanan is a coal they know how to use really well, so that probably stays as well. And that's, right there, you're probably at 4 or 5 million tons out of that 10 million ton total. When you start to look at the other companies that are shipping into there, well, a lot of that's high vol. So what I venture is going to happen is, mines like Kestrel could probably backfill it. A couple other Australian mines that have, kind of higher vol, higher fluidity coals that could sneak up in there. And then, we wind up just, the filling the gap with Indian demand, who currently has trade cases against China, who is considering restricting Chinese steel imports. I think it's just musical chairs right now. What I don't know is how much further they're going to react and how much further the Trump administration is going to react. So could that escalate into some tit for tat that I don't foresee coming? Of course it could. So rather than predict it, I'm just gonna we'll have to take it kind of one day at a time. But just understand that at some point, at some level, that does require companies that are participating in these markets to make other decisions. So I don't think it's going to happen in this first stage, but let's see where it goes.
Yeah, interesting. The kind of the setup for what's going on in China. I know there's kind of group of market analysts or talking heads, whatever you want to call them, that are kind of doomers on the Chinese economy and been that way for as long as I can remember, like the Kyle Bass types, right? But
Yeah.
I don't know if you have any thoughts on if the stimulus might have an impact, if the economy is going to start to recover, or if you think it's they've got demographic issues or real estate issues or whatever other narratives you could pick. But do you think they kind of start to see things pick up as far as their economy?
I mean, I think the businesses have already inflected. I mean, my biggest position now, not because I, arranged it this way, is Baba. So,
Oh, there you go.
yeah, like Shrub, for instance, I think was talking about it as a value play. Not 6 months ago. I mean, pretty recently, like October, maybe something like that.
Yeah.
And the thesis sort of made sense. It's like, well, the worst is sort of past China, and if you're a believer in cycles, then things should sort of move up. So, the trade war could be galvanizing for Chinese industry. I think in a lot of ways. I think there's some other sort of notable folks and mutual friends of ours who are very long Chinese stocks as well. So I don't think it necessarily is deleterious to the Chinese economy. It could be it could be productive in some sort of way. But again, what I don't know is how intense things are going to get, or how much the rhetoric is going to get ramped up, or more to the point, how much this is going to rejigger total global trade, to the point where we have to, play musical chairs with international shipments. That gets really far out of my bailiwick really quickly, depending on how far down that rabbit hole we want to go. So, I'll pull it back and say I don't think it's necessarily bad for China. I think competition in general is probably healthy. So I'm not as I'm not calling for the China doomer moment here anytime soon. They have debt problems. They have other structural problems that we could probably talk about for hours. But I don't think that is in play in 2025 per se.
Yeah, interesting. I think you're right that it's probably not going to be some Chinese Great Depression. I know there are some structural issues that people have made kind of a compelling case on, but I know there's also some very vocal China bulls on where things go from here. But I think with that, it'd be kind of a good place to transition into some of the different coal equities. I know you guys have been focused on a lot of the big names, and one of the ones that I own for a while and no longer own is I figured we'd start with Peabody Energy, which is kind of the one that everyone loves to hate. But they recently did a mine acquisition, and I was joking on Twitter that the management is basically allergic to capital returns, which is kind of what everyone is wanting out of a company that's trading that cheap. But if you want to maybe elaborate on the recent M&A and the outlook from here, I think that'd be a good place to start.
Yeah, well, I mean, there's two ways to think about it, right? The first is from our perspective. So the thesis, heretofore has been that, Peabody's got all this money. They've sunk it into Centurion. It's going to be this big cash cow. What are they going to do with the money? They're going to give it back to you or whatever. And what do they do with the money? They go and buy Anglo. I was on a podcast with the Money of Mine guys and our marsupial friend on Twitter, the koala. The conclusion that we had was basically, they overpaid, right? Did they overpay by a lot? That's debatable. The one point that I tried to drive home on that podcast was that none of us control when those kinds of assets come up for sale. And if they go up for sale and people are interested, somebody's going to win it. And it's just a question of trying to figure that out. There's an outside chance that the deal doesn't even close. I think that's 1% to 2% chance or something like that. And then somebody else winds up coming in. But when assets like that come up for sale, you're producing in region. I completely and totally understand taking a swing at it, especially when you have, a company like Peabody that has access to capital. That's probably better, I think, than most in the industry. And when you are more levered to, a thermal coal market even though I think we're past the point where, everybody thinks thermal coal is just going to die a death. I do think there are still question marks as to how, robust the future thermal coal prices will have with the advent of U.S. LNG exports and those sorts of things. I think there's some question as to what the entire power market looks like beyond 2040. So I get it. I get why they did it. I probably would have wanted to pay a little bit less, but we'll see how it goes. They have the option to sell down a little bit of the acquisition. They could sell, they could sell down part of Centurion if they want. They could sell non-core assets. They could let go of the PRB. There's other things that they could do to make the transition into, kind of a longer-term met coal play that sort of makes sense. So from my perspective, I'm just going to let them cook a little bit. I think the stock has been punished to a cartoonish extent at this point. It was trading with a 16 handle. I don't know what it's doing today. I haven't looked.
I can pull it up.
Yeah, but it was back up into the low 17s. In my mind, like even knowing that we're not going to see, a meaningful buyback for a good long while, I just look at $16, $17 and go, well, that's kind of dumb. Is it going to do anything this year with this, macro backdrop for coal? I don't know. Maybe not, but I understand people who are taking swings down here. Completely get it.
No, it's just under 17 today. So, or at least right now as we're recording. So
16 handle, I can get behind that. I don't think there's urgency to build a fully sized position right now to take advantage of what is to come, because I think what is to come is going to be challenging this year. But if you're putting it in a sock drawer for 2 years, it's probably going to be higher in 27.
Yeah, interesting. The one of the things that I kind of look at with that one is the delay for capital returns that has been the story for a while. What's to stop them from doing the same thing in a couple of years?
Nothing.
Yeah, fair enough.
Yeah, what's going to be for sale in a couple of years? Is there going to be any meaningful M&A that they'd want to participate in over there? Are they in a capital position where they could, be serious bidders for it? I don't think so. But I didn't really think they'd win this auction. So
yeah,
it is what it is. I thought it'd be Stanmore, that group that Stanmore had. But they didn't gild the lily at the last minute. So
yeah, interesting. To move on to another one that I still own a small chunk of, Warrior Met Coal. The thing I think with that one, I think it's basically pretty much a layup below 50 if you can hold it for a couple years with Blue Creek coming online. But I don't know if you have any thoughts on the path from today to Blue Creek coming online to capital returns, or basically what you think the next couple of years looks like for Warrior.
Yeah, I mean, again, when we talk about capital returns, we all have to sort of realize that there are human beings that are attached to these decisions, and at the end of the day, all human beings are fallible, and they might not do what we sort of expect them to do. But just from from an operational standpoint, Warrior looks good. I mean, they're going to report after the close today, I think, and I think they're going to do, I don't know, a few cents a share, 30, 40 cents or something like that. They're in this environment. I think the only companies you can really kind of justify holding on to through the cycle are like the lowest cost providers. So, up until the Lear South fire, that was Core Natural Resources, the Consol, Pennsylvania Mining Complex, Longwalls. And for met coal, that's Warrior on the publicly traded side. They have the highest quality material. Number 7 low vol is on par with every PLV Australian coal. Should fetch parity with Australian coal, but often doesn't, which is, I'm gonna lay more blame at the hands of the coal trade magazines than I am at the feet of Walton Dale on that. But it's recession proof. I mean, even when the market's in the doldrums, Warrior's still going to make money, and the same kind of goes for NRP, for the royalty side of the company. So if you want to hide out during a downturn, the low cost providers and the royalty companies are the safest places to be, just in general. It's hard to get. I mean, a lot of that move from 20 to 23 up into 24 was beta from coal price increases, beta from outperformance of small caps relative to large caps in these sorts of periods. So there's a lot going into why they just crushed it through February of 24. But when the market is moving in the other direction, we don't get all those headwinds at the same time. So I do think it's going to be, Warrior, like range bound, call it from 50 to 55 at these low prices. But when we get back up into the 250 range, call it 27, 28, or if we have flooding conditions in Australia, then Warrior winds up being $110 stock. I think pretty easy.
Yeah. Do you think? I guess as far as the potential for capital returns, like what do you think that looks like if they are able to turn that on after Blue Creek?
I mean, in my ideal world, Warrior gets acquired by a company like Alpha, who is committed to doing buybacks, and then hilarity ensues as those funds are unleashed on cleaning up the register as a war. Is that going to play out? I don't know. We'll have to wait and see.
Yeah.
But could they be acquirers? I don't know. It doesn't seem like that's been their bag. I think they just want to operate those assets well, and probably flip them to somebody at the end of the next cycle. So it might have to do more with an acquirer than it does with them. With Walton Dale personally. I'll have to wait and see. This is going to be an interesting. This is a story to watch.
Yeah.
But I mean, if you want to own assets in the U.S. that are just absolutely bulletproof in recession, you own the Alabama mines.
Interesting.
Mm-hmm.
Yeah, the way I've kind of looked at it is with the low cost, high quality, and their operations. You kind of look at them, it's like, okay, you're not going to have some of the issues that other producers might have. But you mentioned AMR, and that's been another one that's basically been taken out to the woodshed over the last year. And I think it looks pretty interesting down here as far as valuation. But as far as the kind of next, I know you said 25 is looking fairly weak, but as far as the long-term future for AMR, like I think it's hard to see a scenario where if coal prices don't start moving up a little bit and the buybacks don't, like if they turn on again, I have a hard time seeing how buying here doesn't work, at least over the next, say, 2 to 3 years. So you kind of in the same boat.
Yeah, no, I mean, I don't want to say it's a no-brainer down here because again, we might be in a situation where the whole sector just eats glue for for a year and a half. I mean that could very well be the case. So if you're month to month minded or quarter to quarter minded, you're a professional allocator in those sorts of ways. These stocks might not be of as much interest beyond periods where we have the wind at our backs in terms of price, just capturing tiny little bits of beta between now and then. But for deep value guys, like, a lot of the people on Substack tend to be like this, you want to invest counter-cyclically, and this is most certainly counter-cyclically with regard to met coal. AMR is going to have 500 some odd $1 million of cash on their balance sheet, after this quarter. I mean, I don't know if my models are right. We'll see. But they're in a really good position. They could develop something. They could make an acquisition if they wanted. They could just stand pat and do what they've been doing, and good old fashioned block and tackle. Keep costs down and try to generate free cash flow at these levels. They have great optionality. They have a really, what I'm biased to say is, who I think is the best executive team in the business. They have scale. They can, blend met coal, and they have a variety of customers they can sell to. They understand what those customers' sales dynamics are. Like, they're going to be just fine. So, if your time horizon isn't 3 months or 6 months, all the U.S. met coal guys, I think, are in play. I definitely love AMR below 200, but again, I don't want to get anybody's hopes up for speedy returns on the met coal guys this year, because that's probably not going to happen. I think it's just we're at the accumulate phase.
More of a 26 story or farther out.
I mean, so when one of the I lost the spreadsheet, otherwise I'd pull it up and I'd show you. The difference between the U.S. and the Australian stocks is that, the producers in Queensland, the higher the price goes, first of all, the higher it goes in terms of Australian dollars, and then the more government take kicks in at those higher price. So as prices move up, the U.S. stocks are going to have more torque to the upside because they're actually going to be able to capture all of that incremental.
They're not getting hosed by the government.
Right. Yeah. They have royalty agreements with private shareholders or private royalty owners, and those levels are constant. So everybody makes money. It's a much better arrangement with regard to that. The first movers, and probably the strongest movers, are going to be the lower cost producers, because they're going to be the first ones to have margin acceleration that's really meaningful. You're going to be able to see it on the bottom line, whatever. But when prices really get going, up above 200, 300, then you start to see alpha's scale kick in. And when they can capture, really high markets at 16 million tons a year,
they print money, basically.
Yeah, like they're an unstoppable force. So, HCC is probably going to be the first mover when we do get to that point in the cycle, but I think alpha is going to be the furthest mover when we get there. So that's kind of how I think about each of those things. And if you talk to Monish Pabrai, he would just say, "Well, just own all of them and don't worry about it." And of course, we say that, and we all watch, how kind of these fluctuations in the wagons fund happen. But he's right about that. I mean, if you don't care, and it's money that's going to be paid to you in 20 years or whatever, you can kind of just set it in a drawer and leave it alone and kind of move into the I don't even know what the share price is category, because when the market does really take off, it's going to crush.
Yeah. There has been other M&A that I think would be interesting to cover with Console and Arch turning into core resources.
Yeah.
That's one where I wasn't as familiar with assets, but I think the thing that's interesting, and I'd be curious to hear your thoughts on this, is do you think there's maybe more M&A to come kind of in the future for the whole sector? And then maybe if you get into what you think the combined entity looks like over the next couple of years for that one.
So for core, well, I mean, this is a merger of equals. These are two very big companies. Consol's assets were very concentrated, pretty much the entire Pennsylvania mining complex. And then they had the little, much smaller Itman mine down in Central App. Whereas, Arches has the Northern App mines in Lear and Lear South. They have Central App mines in Mountain Laurel and Beckley. They have the PRB, like they have Western Virginia. They're all over the place, right? So the combined company, which is now run by Arch Management, it's run by Paul and Deck, right? They're going to have their hands full doing two things. The first would be kind of just absorbing, the work culture of the Pennsylvania mining complex, which, in my opinion, is probably the best run coal mines on the planet. Certainly for longwalls. I mean, they're heads and tails above everyone else. Now they have very good operating conditions. Seams are 6 feet thick and consistent. So they're able to get to best practices much quicker, right? In other areas of the country, like seams will dip and move, and you have to kind of follow them. In the Pittsburgh 8 seam, that's not necessarily the case. It's very very thick, very consistent. What my sort of suggestion was when they merged was that operating culture needs to be transferred over to Arch, because that's been the one kind of knock on Lear and Lear South, is like those are more difficult mines to operate. Are they operating the most efficiently? Like, it's not exactly a longwall culture at Arch, et cetera, et cetera. Whereas that's what Consol does. So you think about their expertise, they're longwall guys, right? So I would think over time that would be incredibly beneficial to the operating environment. Of course, right before the day before they merged, there's a fire at Lear South, and the mine shuts down, and it's going to be out for they say 6 months. I have heard anecdotally that it could be much lower. I've heard that there wasn't much damage, if any, to the longwall at all, and they might be back up and running sooner than the 6 months have suggested. And then I've heard other folks talk about how no, it's 9 to 12 months. There's no way they're going to be back up and running. So we don't know. We don't really know. We'll find out on February 20th. I think a little bit more definitively, and I think it's prudent for all the analyst communities to just give Paul and Deck a little time to cook and see what's going on down there. Once that is resolved, this company can really generate some free cash flow, right? The synergies between just being able to ship out of the Consol terminal in Baltimore for Lear South is huge for Lear and Lear South. You get the benefits of scale with CSX, exporting through Baltimore. You get the benefits of you can blend down the sulfur if you want to in some of the Bailey coals that they've been selling to China. You just all of a sudden you have a lot of optionality that you didn't have before, and this is what scale does to companies, right? Yeah. So I'm pretty optimistic. They got pretty punished for the Lear South fire, which obviously they should have. Share price should have gone down, but down in when it was down in did it make it down to 70 something, 78, 79?
Yeah, I think it briefly. No, right above 80s looks like where it's been.
Yeah, like down around that level is kind of it's probably too low. And this is with full acknowledgement that this is not going to be a great year for coal. I mean, I haven't done all the math yet. We'll put out an earnings preview for core next week, so we'll get into it here over the next few days. But just thinking about it abstractly at the moment, yeah, I think it's going to be pretty good. Are they going to acquire something 2 or 3 years from now? I don't know. I think they have their hands full at the moment. It's hard for me to sort of speculate. I would think that there would be other companies that would be sort of more likely to do M&A for the next few years, and maybe Core acquires them in 2030, 2031. I think that's probably a more reasonable timeline.
Yeah, interesting. And on the more M&A topic, there have been a couple of bankruptcies, including one you wrote about recently with White Forest. I think that was a private producer, if I'm not mistaken.
Yeah, it was. They have 2 mines. One is South Fork. One is Ravencrest. Ravencrest produces 250,000 tons of high vol and thermal coal. And South Fork is about 350,000 tons of Sewell seam mid vol coal, which is very, very hard to come by. Really good product. Everybody who could buy from South Fork and work it into their blends pretty much was. So
interesting.
See them go under.
Yeah. Do you think that's potentially something that we'll see continue as far as smaller guys going under or getting acquired?
Somebody's definitely going to wind up with South Fork. Who I don't know. Whether Ravenscrest is attractive with all this high vol coming to market. I don't know. I guess we'll see. They said they have a stalking horse bidder for their assets in the bankruptcy. I was surprised to see they had $79 million in debt. That seems like a lot for a small producer. But
yeah, interesting.
But somebody's going to wind up with South Fork. It's too good of a quality coal not to, and it's underground mine again. Like that skill set isn't going away. You need to kind of where you have really good miners who understand
an asset,
who understand an asset with good coal quality. I mean, I would think somebody's got to come in and try to right that ship.
Yeah, interesting. I do have to ask about Corsa, which my buddy has been nagging me about. I told him you were coming on the podcast. And I was like, I figured I'd bring it up, but they declared bankruptcy recently, and he was kind of asking, what do you think kind of high level that looks like moving forward from here? Because I know he said he was surprised that they declared bankruptcy, but maybe if you could just give us a 30,000 foot view of that one, I think that'd be interesting.
Sure. Well, I was surprised to see it too, because at least by my models, they had enough cash to operate for, at least another 6 months before we had to really worry. And I guess what sort of triggered it was they were expecting to get a loan and they didn't get the loan, but they never really talked about that or divulged it to anyone. So, unless you were talking to Kevin directly for a long time, you didn't know that was an issue. And then separately, it seems that they put all their eggs in this USDA basket for the loan instead of just actually going out to shareholders and saying, hey, we need to recapitalize. Would you be interested in a private placement or, issue some equity? Or there's a lot of ways they could have approached that to get over the hump, and they just didn't. So, they filed. That sucks for shareholders, but it kind of pissed me off because, if that's all the capital that you need, there are more than enough people to go find to get you through that period. And the debt for relative to the size of the asset, it wasn't 79 million like White Forest at 600,000. We're talking, 20, 30 million for a 1 million ton a year mine with a really high quality low vol product. And they're, we're not making any more low vol. So to me, it just seemed stupid.
Well, and there's plenty of people that are already involved that for sure have deep enough pockets to organize something like that.
Yeah. So more than anything, it just kind of pissed me off, I think is probably the best way to put it.
Yeah, fair enough.
And and they're publicly traded. They have shareholders that have been with them for years. The Lundins are shareholders, for God's sake. Came in and recapitalized them years ago when they did some sort of arrangement with Sprott. Sprott brought in the Lundins to help cap that. You don't do that when those people are involved. And I don't know if they just don't have that awareness of culture, or I don't know what it was all about, but it's total bullshit in my mind that they filed in general. So now the worry goes from, how are we going to, help out shareholders to what's going to happen to these jobs now? They had a fire, a couple of days at a facility, not long after that, which seems really weird, to say the least. And, and I forget how many miners they have, but that's where my mind goes. It's we're not educating enough coal miners. We're not training enough up. We're not taking care, culturally, the higher quality assets that we have on the raw material side for steel. somebody's going to wind up, I think, doing the right thing here, and making sure everybody's making sure the miners have jobs, or is taken care of. But what shape or form that's going to take, as we get forward into that process, I don't really know. All I can say is, like, if there's anything I can do to on my side to help, I certainly will. And we'll see. Deep breath, and we'll see how it goes. But I would expect to see those mines continue to produce through the bankruptcy, and through whatever process is next. So but that's as much as I know, really.
Interesting. The that's one I've looked at, and I was like, it's cheap, but it's also there's a lot of moving pieces, and with it being microcap, it's hard to pull the trigger on it. But
it is, and it also highlights single asset risk, right? So if your one asset isn't performing well, and they really did not perform well last year. I mean, they had costs up at 150, which is basically what they were getting for the coal. So when that happens, I mean, there's not much you can really do. I mean, your days are numbered if you can't produce. Like Rick Rule says, you can't produce. Produce something for $150, sell it for $149, and make up the difference on volume.
Yeah.
Just doesn't work like that. So
unless you're a tech company in venture capital.
Yeah, I mean, look, like they need to be recapitalized, right?
Yeah.
They've got a plant that I think is worth a fair ton of money just to run as a tolling operation. They've got pretty decent low vol assets. They've got a project that could be developed if somebody puts the capital into it. Like there's something there that somebody's going to be able to get a return off of, but you got to get management the hell out and find somebody to really run the operation. I think that's pretty clear at this point in time. And so, fingers crossed, and I hope it works out for the shareholders. And, like I said, we'll do what we can on our side to help if anybody cares.
Yeah. I know I got a couple of readers, at least in Australia. I figured that would be something they'd want to hear about. With I've looked at Whitehaven a little bit, Yancoal. You'd mentioned Stanmore earlier. But I'd be curious to your thoughts on kind of the general outlook for those, and maybe how they compare to the U.S. But also, if you have any favorites in Australia, I think that'd be interesting to hear.
I mean, with markets down where they are right now, I think Yancoal, like lowest cost producer, right? That's Yancoal. And they run those mines really well. They're dividend focused, like they have a shareholder return policy that's already kind of in place. It doesn't look like they're going to wind up getting. Pardon me. It doesn't look like they're going to wind up getting Kestrel. So, it might be M&A is off the table for them. And so right now that's where, on the Australia side, that's where I'm mostly focused. If I had to choose between Stanmore and Whitehaven in this environment, I'd probably choose Stanmore, only because the thermal coal in the Pacific Basin is inflecting lower, which is going to kind of hurt Whitehaven's bottom line. Whereas I think met prices are comparatively stable. And because Stanmore actually gets a discount relative to PLV, their government take from Queensland isn't quite as onerous, even as Whitehaven's. So, I think it's probably Stanmore slightly over Whitehaven for the next few months or whatever. But longer term, both are fine. I think Whitehaven's going to crush it. Longer term, you'd probably flip flop them if we're talking the 5-year time frame.
Yeah, interesting. The one thing I remember looking at, it didn't seem like they overpaid as much as, like, say, Peabody did when they did the big acquisition.
And they were able to sell down 20% pretty quickly.
Yeah. I guess before we kind of move into starting to wrap up here, I do want to ask if there are any other sectors or any other companies, areas, geographies that you find interesting outside the coal sector. Because I know we kind of hit on some of the big names in the U.S. and then talked briefly about Australia, but I'd be curious to get your thoughts on anything else that you're seeing in the market right now.
Well, I mean, I mentioned my biggest position right now is Baba, and that's not because it was by design. It's because it's just done really well. So I probably need to be selling it here as opposed to increasing exposure. But I think the China inflection is pretty well known. On the tech side, on the AI front, I think we're basically making a move from the picks and shovels that sort of kicked off the run, in NVIDIA. And we're kind of even past the networking type of plays, that would be sort of the second beneficiaries of an AI boom. And so now I think it's, you have to turn your eyes more to, and this is definitely not my bailiwick at all, but you start to have to turn your eyes to, well, as the cost of compute goes down, who is going to be able, from a software, from a services perspective, make use of that lower cost compute? So you have to start looking at agentic AI beneficiaries. And I mean, there are a few, but when you start to get into AI as a service, like the landscape just kind of broadens out to the point where there's going to be a whole lot of people who benefit from it. But that's where I think the kind of next leg of that movement is. And we also had this when the DeepSeek announcement came out, we had this like big sell-off in all the power providers.
Utilities and nuclear and other stuff.
Yeah, that had made these big inroads because of all the hyperscalers are coming, and we're going to need all this power. Well, it was like that release just all of a sudden went poof, and we don't need power anymore. When the truth was, all of those companies just ran up on the speculation that we needed more power. We haven't built any more plants.
Yeah,
we haven't done anything at all.
No, it's just market flows at this point.
Yeah. So, and then, I have no idea how to think about Jevons paradox in the context of this round of AI. But if it's anything like, energy efficient appliances, it means we're going to compute more and use the same amount of power or more.
Yeah.
And so it's hard for me not to be, just very constructive on long-term power prices, which means, utilities are going to do well. Anyone who can manufacture value with hyperscalers, with a behind the meter sort of platform, all that stuff is very interesting. There are a lot of, coal companies or people who are interested in coal who are also kind of kicking the tires on those types of ideas. I mean, I even asked Jim Gretsch on the Peabody call, like he said, there's private equity that's asking about those sort of things. I tried to get him to elaborate on it, and he just kind of went, well, there's private equity talking about it. So it's still formative stages, and I don't know who all are going to be the beneficiary. But the easiest call I made on, DeepSeek Monday or whatever that was to buy Hallador at $9.45 or $9.50. Just plummeted down from 13. It's already at 11 something. I mean, I wish I would have bought more. I mean, I only bought like a 1% position or something like that, 1.5. So, I was sized, like it was going to zero, and I should have thought that through a little bit more. I just bought it because it got too cheap too fast.
Yeah. Interesting.
Yeah. So like that's, but those are the things that I think are interesting here this year. I still a big owner of precious metals in general. Gold's certainly going to 3,000 at this point. I bought silver calls the other day. Like, so like,
well, if LBMA blows up, then we'll see what happens there. But
yeah, so I think there's reasons to be constructive on precious metals in general for the longer term. Now, if we have like a de-escalation of geopolitical tensions, right? Russia-Ukraine peace. If we have Trump dials down the trade war, that's deflationary for gold and silver. For sure. It's definitely going to be. And we aren't going to know when those announcements come out. So, I'm keeping stops tight and things like that, but I'm pretty constructive precious metals. And I think copper was in a part of the cycle, a month or so ago where it was got pretty constructive on it. And I think prices are going to be in a range between 4 and 5 until global supply is solved. God, what else? The nuclear and uranium trade also went down on DeepSeek news, and that was a buy because it went up on air and down on news. It's going to go back up on people coming to the realization that the news isn't really news; it's all just changing the 5-year speculation.
Yeah.
So pretty constructive on that. I think it's going to be. I mean, it's already been a good year for biotech thus far. It's hard for me to comment on specific names when I get too far outside of my core area. But like that's the kind of stuff that I'm doing, in my 401k, and our Substack friends like the Shrub and Citrini. I think Citrini's Substack is just fantastic. He covers so much. I mean, such a broad range of topics. He covers them really well, and you can read a piece and kind of get sort of up to speed on it. And so when those guys circle around an idea that's going around in my head, it sort of kick up and take notice. Like, okay, there must be a thing there, and that's worth looking into. So it's always positive feedback for me if I accidentally back into one of the things that they're talking about.
Yeah,
that's kind of what's going on, in the water 401k right now.
Yeah, interesting. I do have to ask one last question because you mentioned the data centers and kind of how it connects to coal potentially. If you had to guess, if we will see a kind of coal-powered AI data center, if you had when and where would that be? If you had to speculate, I guess, on where that might happen.
I'll go ahead and be ballsy and say, yeah, it's probably going to happen. I'm going to say it's 2030 and it's in Wyoming.
Powder River.
I think so. I think, somebody at some point is going to look at that confluence of factors and just pull the trigger. They have, they've got carbon capture and sequestration possibilities out there. Pacific Corp is doing this project that, Thomas tried to get Peabody involved with, and Peabody bought Anglo instead.
And the rail cost too, to get it out of Wyoming, right?
Yeah. But I mean, you could see something where, all right, you get permission, under a Trump administration to build a new coal plant. Where are you going to put it? Well, let's put it right next to a mine that we can go acquire, right? Arch's PRB mine is most certainly going to be up for sale. I bet you Peabody would consider parting with North Antelope Rochelle. And these are dollar margin mines, so these aren't real big, big dollar acquisitions, but for each of those mergers, that would be really material, and they get a whole bunch of risk off their books that they don't really want to deal with, and you find a new, more constructive avenue to which to deploy the material, so that your collateral that you put up for the sureties is at least going to something. Like as it comes back out, you can make sure you invest in the mine. All that money flows through to the plant. It flows through to the hyperscaler that's benefiting from the behind the meter transaction. It's a corporate development project at this point in time, but I'm just going to go ahead and say somebody's going to do it, and whoever winds up doing it, give me a call. Happy to help. However I can.
Well, I kind of figured they'll make a fortune doing that with kind of the setup there. How much do you think a project like that would cost?
Well, I mean, it's probably $300 million for the plant. Probably $300 million for the mine acquisition. $250 million, something like that. But couldn't Microsoft just finance that?
Well, that's a drop in the bucket for a company like that, but
exactly. Go to a hyperscaler for financing and try to. I don't know. There's a.
They might not want to touch that though. With the big tech companies touching anything coal related,
I mean, they just restarted 3 Mile Island, acquired 3 Mile Island. So
yeah, fair.
Who knows? And if you're doing CCUS, does it really carry the stigma that it would otherwise? And and then you have, further optionality if you wanted to go beyond that. I mean, I don't think any of this is going to be front of mind in a Republican administration.
Yeah.
That's more for, the inevitable anti-incumbent backlash in 2028, right? But I think there are going to be options to either mitigate the carbon emissions or mitigate something, or save public. I think there's going to be a lot of ways to skin that cat.
Yeah.
So I think it's something that people ought to think about, and we'll see where it goes. Right now, nobody's quite pulling the trigger, but I think in the next decade we'll probably see a CCUS project that works. I mean, the economics really work when you take the transport costs out of it. So if you're going directly from mine to plant, and you're belting it over there, as opposed to putting it on a rail car and moving it down to Texas. I mean, the economics of those two situations are night and day.
Yeah.
So I don't know if you can just build it anywhere and then ship PRB coal down to fire it. I don't think that'll work. I think you got to build it in Wyoming,
mine, and then plant, and then data center, basically.
Yeah. And Travis Detai at the Wyoming Mining Association will tell you, hey, we got a lot of people ready to work out here on any of those things. They'd be happy to help. So, attitude makes a difference too. I'm sure Senator Barrasso would tell you the same thing.
Yeah.
So yeah, let's just say it happens. I think it's going to happen. Are there going to be more than one? I don't know, but I'll take one.
Yeah. Got to start somewhere. So
that's right.
Before we wrap up, I do have to ask my traditional closing question, which is, what book do you think I should add to my reading list? Last time you were on, you gave me Narrative Economics by Bob Schiller and Thinking Fast and Slow by Daniel Kahneman. So do you have another one to add to the ones you've already given me?
The answer is yes, but now I have to think about what it would be. Yeah, I do. This one's hard to find. But if you want a good coal history book, there's a book called Buried Treasure that's written about the formation of Arch Mineral, which is now part of CNR.
Okay.
And it was done by this biographer that he also wrote a sort of corporate history of Raytheon, which is also really interesting. But it is one of the easiest reads I've ever breezed through. I mean, granted, because I know a lot about the coal industry, but the thing that I loved about it is you start looking through, you start seeing these names that pop up, and they're names that are associated with either mines or plants or loadouts or even current CEOs of certain companies. And so those, everybody just all of a sudden gets really familiar. If you know anything about the industry, if you know the people who've been involved, or if you've been fortunate enough to meet them like I have, all of a sudden, like, these people become sort of peripheral characters in the book. And it's a great read, period, stop. I love reading corporate history in general. But this one, obviously, it hit a little bit close to home, and some really interesting, fun names that are in there.
Yeah, I'll have to definitely check that out. If my listeners are looking to find your work or your social media, where can they look for that?
More places than ever these days. For sure, you can come find us at thecoaltrader.com or thecoaltrader.substack.com. You can follow me on Twitter at mfwarder, where I pretty much just talk about coal, and occasionally some other things. And you can follow. We have a like a Newswire Twitter account that I put stuff out on occasion. That's at Coal Newswire. And then if you subscribe to the Substack or to the premium service on the website, you also get access to the at the Coal Trader Twitter handle, and we have Discord as well. For subscribers. So a lot of different ways to come at it, but thecoaltrader.com, mostly the hub there.
Yeah, it's definitely worth checking out. The Discord's always entertaining. So if you have the time, definitely go take a look and support his work. But I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.